Good evening, everyone, and welcome back to the conversation. You guys know the show as the Nate and Drizzy Show. We are kicking ass and taking names here on this wonderful Thursday, the 19th of May. And we should have a hell of a show up for you. A few things first that I want to get out of the way. I am your favorite curly-haired bastard, Tyberius D, and I appreciate you guys rolling in, whether it be on the YouTube or the Twitch. I know that this is one of your favorite shows, not only just for me, but also for the community at large, and I want to thank these two wonderful gentlemen for being here tonight. First, he is an immigration lawyer out of Omaha, Nebraska. Thank you, Nate Allen, for showing the hell up. We know you, we love you, and we wish you could be here more. He is a political operative for the Democratic Party out of the wonderful D.C. area. That's all we were allowed to say about that. But we do know that our good friend Sam Drizzy is doing the real political work that you all wish and dream that you actually could. And so we've got two experts here today, kicking ass and taking names. And you guys know this is one of my most popular shows. You can actually look up the views on YouTube. Does pretty much the best that we can do outside of like a random geopolitical thing that I do. So without further ado, we're going to be talking a little bit about econ, finance, interest rates, a lot. And we can go 1,000 different ways to Sunday on this one because this show can easily last 3 hours and no one get bored. Of course, we won't be able to do that tonight. We all have time limits, and I'm sorry that I'm starting late. That was my fault. So if any lack of content thereof, that is Tiberius' fault, not these two wonderful gentlemen. And without further ado, the last thing I will do is I'm eating. So I may go off cam. You might not see me for a bit, but I will be here. So don't worry about that. But first, Nate, are we going to do the presentation? Or are we wanting to kind of just flee-lie this? How do you guys want to take
I'm totally fine. I was hoping that Sam would give us some of his initial thoughts because a little weird thing happened today. I was finally going to talk about family deterioration and family formation in the country. Yeah. But a couple of interesting things happened in credit markets today that were relevant, and it kind of got Sam excited, and I was also, for unrelated reasons, excited about today. So I don't know, Sam, if you want to give us a little thought as to what you saw.
Before you do, I just got to interrupt one little thing. Nate, check your mic input.
Oh, crap. Fine. Hold on. Oh, yeah, I'm on default. That's naughty of me. Nope.
Am I different now?
You are very different.
Worse.
Oh. But you're very low. You're far clearer. Can you boost that up a little bit?
That's right, yeah. The clarity is there.
Boost?
Yeah.
I need to boost myself.
There you go.
Push to talk. Nope, that's not it. Input mode. Nope. Voice settings.
You're pretty good there. The boost should be on your mic. But, all right. Sorry for the interruption, but I knew there was some audio issues there, and I knew people were going to be upset because they want to hear your lovely voice serenade them.
Of course, I'm sure. All 4 of my fans are really worried.
Dude, anytime you share anything on Twitter, hey, I did this show, I double the viewership. So don't act like you have 4 fans. You probably have 40 plus.
Maybe.
All right.
So, Sam, get us started as to what you saw in credit markets today and why that's relevant.
Well, it's not just today. It's the last week or two. I mean, I've just been watching it with a huge amount of enjoyment as everybody flips out about crashing markets. And I, in particular, I had a great time watching the reaction to the last Fed interest rate hike.
Oh yeah,
which was last week because I think it was that day, or maybe it was the previous day. It wasn't the Fed interest rate hike. It was the reaction to the CPI data. Because it was above expectations. So markets crashed like crazy, right? And everybody was flipping out, right? But what people weren't paying attention to is that despite it being above CPI being above expectations, whatever the Wall Street bettors were betting was the spread, it was showing disinflation from the previous quarter and the previous year.
Right.
And that we're not talking deflation yet. We're talking disinflation. But what it means is, like, the thing that's been driving, this is what people don't realize about the stock market. It's not driven by news. It's actually driven by the bond market. And the thing that has been destroying both crypto and and the stock market over the last months has not been any kind of news or people, afraid of this or that. It's literally just yields on the 10-year bond have been going through the roof. But over the last week, this is what's happened to me so excited. Over the last week, especially since that CPI print, that's what triggered this. Since that CPI print that showing disinflation, yields have been crashing and look to be rolling over. I mean, there could be one last, spike higher again, but I'm not saying that it's over. But things look toppy in the yields, and the reason why I'm so excited about that is that it's a leading indicator. Yields are a leading indicator for the bond market, and the bond market is a leading indicator for the stock market and crypto. So I think that everybody's doom and gloom right now, but they don't realize that things are about to turn around very, very quickly. And Nate, they put together some slides, so I don't want to talk too much, but his data, I think, is gonna. It's not as simple and cut and dry as the way I'm putting it, because there are a lot of countervailing forces, right? But I'm excited to see how it turns out, because I don't think it's as doom and gloom as everybody thinks right now.
Just real quick, when you said you're expecting things to turn around, what do you mean by that?
Oh, I'm expecting markets to rise again and for people to feel rich again when they look at their portfolios.
Gotcha.
And did you see the contrarian economist? Wait, what's his name? David.
Hunter?
Yes, David Hunter. So David Hunter made that exact call today where he said, okay, yields have topped. The yields are going to start running down. He also said that the dollar on the international market is going to start to weaken, and market for asset prices is about to occur, and then deflationary hell. That was his call today. I mean, he's made versions of this kind of call over the last 2 years. And so I just thought that was interesting because somebody else today saw the same thing that you did, Sam.
Yeah, I don't think that even the two of us were the only people to see this. I think a lot of people are watching this. They just aren't necessarily on YouTube, because YouTube is pretty full of pretty unsophisticated actors. If you're taking
an outrage. I mean, this idea of like, oh no, things are about to get better. That probably wouldn't get you a lot of views on the.
That's
YouTube.
right. That's right. It's not going to. People will start. You'll have lots of angry comments of people telling you there's this guy named Steve Van Meter who's been doing, he's basically been saying for the last 2 years on YouTube that inflation's about to peak and bonds are going to go crazy and the stock market's going to crash and whatever. And everybody has been beating him up for a year and a half. He can't get any love on YouTube because everybody's like, look, I go to the grocery store and I'm buying corn and it's like, it's like $6 and it used to be $1, right? And they're using that as a proxy for major markets.
So just out of curiosity, because I don't know who you're talking about, has he been saying it's like, look, for about 2 or 3 years, you're going to see some really high inflation, but after that, it's going to start coasting off, and we're going to go back to normal?
No, he was wrong.
Okay.
He did underestimate the amount of inflation that there was going to be. But he's not a chart analyst. He's not a geopolitical analyst, so he's not smart on those things. The thing that he is he's an expert on the bond market and on the Federal Reserve policy. And so he's probably right in the long term about that. He just can't get the timing right because he's not those other things in it.
Yeah, but I mean, check this out. We say, again, just doomerism definitely sells, because if you take a look...
Right, and he's changed his marketing around his, because you can see if you go further down, his stuff
the old days. You look at this 11 months ago.
We're just
macro thesis update. Yeah, I see
that. Right. It's like less fire in the streets stuff, and then you go up. And look at his thumbnails.
Yeah, I mean he's totally turned this thing into a death ball, which is interesting.
But he hasn't changed his argument. So, but anyway, if you look at these thumbnails, you can see what sells on YouTube.
Yeah, for real. I find that to be very interesting. That's that's a separate kind of question. But yeah, okay. So to Sam's point, something that I realized getting into the end of April. Okay, I should take this back. There is one guy that I follow on Twitter. His Twitter handle is the Plunge Protection Team, and he claims to be a banking plumbing guru. He's super anonymous, so we know he lives on the West Coast, but we can't quite pin him. We think he used to work for one of the Fed banks, probably out of San Francisco, but we can't verify that. And it looks like he works for one of the big hedge funds as one of their top analysts. But he started hitting this way at the beginning of 2021, where he said, guys, the credit markets are going to hold the economy to get together. The doomers are wrong, at least in the short run. And I didn't take him super seriously, I have to admit. I was like, man, demographics, like all the reasons to be a doomer are so powerful. I ignored him. But then I started taking him seriously. I started tweeting at him. He's very gracious with his time. By the way, people who diss on Twitter, they're just wrong. Twitter has been lovely to me. I have learned a lot of things about real life. If you just ask actual questions and do some things to be kind to people, they will be kind back to you. So I just want to float that out there. If you don't use Twitter as a rage machine, it will be nice to you. I just want to float that. But this guy, he's all about one topic, and that is how much more can the banks loan without things getting scary, right? So one of the ways to think about the 2007-2008 crisis is not actually to focus on the housing piece or even to focus on the collateral and asset piece. It's just to look at the balance sheet, how much credit was in the system and how much of that credit was dangerous that could bring the whole system down. And he highlighted this. So if you look, this is from the New York Fed's office. They released this report at the end of April. So I think it just dropped 10 days ago to the public, the end of the first week of May. And this is the total debt balance and its composition for consumers. So source down at the bottom, New York Fed Consumer Credit Panel and Equifax. Equifax should cause everybody to go, wait, what? Yeah, this is the people who give you your credit ratings, right? And here is the distribution of debt inside of the economy. Now, I just want to highlight a few things. If we take a look at this, and I think I don't know if you guys can see my mouse pointer, but if we come down to Q103, and then we draw a straight line up till now, the only period that's really above trend is that period of the Great Financial Crisis, right? So we got a little too steep between Q1 of 03 and Q1 of 08. Too much credit was created, too many bad loans were taken on, and so that's why you have this interesting little kind of collapse. But look, the collapse wasn't nearly as bad as we anticipated, and then it sort of bottomed out pretty quickly by Q1 of 2014, and then it's had a much more gradual rise. Why is that important?
Now we're back to where we were. Almost.
Well, in absolute terms, Ty, you're exactly right.
By the money supply, though.
Yeah. Now, this graph would lead you to believe we have way more debt than we've ever had before. This seems like a total crisis, et cetera, et cetera. Okay, it's an interesting point. That's why you got to dig a little bit deeper. So here's the next graph to give you an idea about how bad that 08, 09, 2010, 2011 period was. These are delinquencies, Ty. So if you look at this will give you a better sense for how unhealthy the debt was during that period, and then look how healthy the debt is now. So if you look Q1 2003, we were higher than we are currently right now. But by the time you get to 08, 09, look at those delinquencies, right? They're it's just huge. And then we've had a gradual collapse all the way down to where we are now. So this means two things for us. One, the debt that we have now is way less risky. There's no indication that we're having a lot of delinquencies and other issues inside the economy, right? And number two, one would hope that the lenders have gotten a little bit smarter and don't put themselves out over their skis, meaning they're not extending as much risky consumer debt. Now, the overall debt load is still incredibly high. I refer us all back to the conversation Sam and I had to kick off this whole show about how bad the debt situation is in the aggregate and in its totality. But in terms of its quality, it is less risky now than it ever was in 08, 09, or 2007 even, right? So that's, I think, are some really important data points. Now, I also wanted to show this, if I can be competent enough to figure that out. Okay, here we go. So these were my thoughts on May 4th, and this is where I was starting to think along the same lines as Sam. So this is when Jerome Powell did his, we're going to do another rate hike. Okay, and so I, of course, tongue-in-cheek, quick thoughts today about the God Emperor Jerome Powell. He lets us mere mortals know how everything is under control. Of course, that's extremely tongue-in-cheek on my part. So I say supply is still down for commodities, but demand remains strong. That means prices are high. We call that inflation, right? So this is, and I have the World Bank. They have a whole bunch of stuff here about food and energy shocks from the Ukraine war, which could last for years. That's really just them saying supply chains are an absolute mess. The Ukraine war made them worse. And so supply is not adequate to meet demand. They anticipate to have persistent high prices for years, right? All across the globe. This isn't just a US problem, it's an everywhere problem, right? Then I say, however, Emperor Powell thinks that these higher prices can be brought down with Fed action. And so then there's this these comments from Powell at the end of March, the last time that he rose rates, saying that we're going to stop people from spending so much money. But I say this, curiously, what is needed is more supply of commodities. And I'm unaware how the Fed can print more commodities. So it stands to reason the way to bring down prices is to smash demand. And when I say smash demand, I mean
recession.
Convince people to eat less, get out less, go to bed earlier, right? Make actual lifestyle changes to consume less stuff.
And you do that by making it harder to get into debt. Can
I ping one thing here, though, real quick?
Yeah.
I was looking at the economic data, and I love our good friend Peter Zion, but like every now and again he's just fucking off the cuff with some stuff. And one of the big things is he's like I think this was literally just at the beginning of the year, we're gonna see a continuous surge of like almost 10% economic growth. Now I thought that was a bit of a stretch, but I figured we're probably gonna pull 5 to 6 pretty consistently. Do y'all see the Q1 numbers this year?
Oh yeah, no, it was negative.
It was negative.
6. Yeah.
Like literally, if Q2 is negative, that's a recession by technical terms.
Yeah, but he's looking at this. You have to take people where they're experts, right?
I know.
And take this. Like I don't doubt that he's like he is looking at things in such a long time frame, and he's looking at the structural underlying things. But the markets will do any number of things that are totally unrelated to the underlying numbers. And also, like, it totally makes sense that we'd have a recession right now. Of course we'd have a recession right now. We've got a hangover from all the stuff that happened during the pandemic. Anyway, so I totally think what you're saying makes sense, but I'm not surprised that he's wrong at this specific moment about that.
Go ahead,
I'm sorry. All I'll say is I am surprised a little bit that we went negative. Like our good friend Phil KOE was being like, "Oh, we're in recession," all this other shit. I'm like, "Wait, what? No, we're not." And then I actually looked. I'm like, "Wait, we're actually in negative growth? How did we get here?" And I was like, I sifted through the numbers for the better part of a couple hours. I think it was about a week ago now, and it's just like, it's not that any of the major factors are changed. It's literally just seems to be people are paying so high out the nose because of inflation that's been constant and consistent that people just either can't afford it now, or people are saving for just whenever they can because it's actually gotten to the point where it's burdensome. Would you guys concur with that at all?
Yeah.
I would only add, when I looked at the data, Ty, the big crunch was that the trade deficit for the U.S. went up.
And the exports went down.
And our exports went down because global consumption collapsed. Well, I don't know, collapse is too harsh a word, but it contracted. So Europe contracted and China contracted in Q1. So that meant even though we're less exposed to foreign markets as other countries are, our exports went down, right? And so that sort of that's where the consumption decrease was. It wasn't so much on the American side, and that's an important distinction. So global growth is running in the opposite direction, right? So like China's lockdown, that's a great way to get people to consume less.
Yeah.
That is a demand-crushing jackhammer, right? This is
Yeah,
like
and people can't-
Odin decided to destroy demand,
Yeah, yeah, Odin.
right? Yeah, one-eyed Cyclops Odin from way up in like Asgard or whatever is like,
Yeah.
we're gonna crush demand. I'm just gonna force half of the nation of China to sit at home and scream out their windows, right? I mean,
Yeah.
that's what they've been doing.
And starving, literally starving,
And
in their
starving because
apartments.
they're consuming less. I mean,
Yeah.
that is the most draconian, we're going to stop inflation maneuver I've ever seen. Now, they have real reasons for health reasons that are unrelated, but it has the effect of crushing demand in China. By the way, what do you think happens to gas prices when China opens back up, folks? Right? Chinese demand for liquid fuel is down 40% over the first quarter. When that demand comes back online, if you think gas prices are high now, just buckle up, Buttercup, right? It's going to be crazy. Anyway. So to your point, Ty, that's the place to keep your eye on. And the thing that's going to save the United States is what we're talking about now. So I want to just hop quick back to this. So banks still have a lot of space to make loans, okay, due to fiscal spending in 2020 and 2021, and a tiny bit still in 2022. Okay, so we still have some child tax credit money is still hitting the books today because people are getting their tax returns back, right? Tax day was a month ago, like yesterday or something like that. And so there's still a couple of families out there that still have not gotten their tax returns, and they will over the next 2 to 3 weeks. And those tax returns are healthier than most years, okay? So that meant debt has been really low, and it has space to ramp back up. So here's another graph. I call this the goofiest graph I've ever seen. So this is consumer loans, credit cards, and other revolving plans, all commercial banks. So just so everybody knows, your credit card might say Visa or Chase or something like that on it. But almost always, there's an underlying commercial bank that is the underwriter for that card that actually creates or destroys the credit as you pay off the card or you put money onto, or you put goods and services onto the card, right? So anyway, that's a little aside. But you can see this graph is slightly misleading because that little like depressionary period on the far left, that's obviously us coming out of the great financial crisis. And then it spikes, gets back up to normal, and then look at that goofy little curve. It's like this little valley. So as stimulus money came in 2020 and 2021, Americans, the consumers, did the right thing. Tip of the cap.
Yeah.
Right? Tip of the cap. They paid off debt and they saved. So you get this goofy thing where you get this valley, but then look, we're starting to get back close to trend. So this particular graph ends at the middle of Q1. So it's not completely up to date. So of course we've gotten back to the trend line. So that just means we're back on track. We're not overly indebted right now. And more importantly, here's the delinquency rates viewed in a different way than we saw last time. And look, they've collapsed. People are not delinquent on their payments. They're doing great. Right? They're doing absolutely great. Why does this matter? Okay. Americans are going to dip more and more into credit this summer to keep demand high. So Ty just mentioned prices continue to go up and Americans need money to pay for stuff. Where are they going to get the money, Ty? Credit card companies, okay? Everyone's going to their credit cards this summer, but everyone's going to feel pretty good about it. No one's going to be in arrearages. No one's going to be going to bankruptcy court. No one's going to be getting hit with a bunch of like, oh, you haven't made payment notices yet, because we're just barely getting back into our credit cards.
Can I lay a narrative on top of this?
Do it.
Your name is Homer Simpson. You've got 3 kids and a wife. And you've been locked up in your house for a couple years. And Joe Biden's telling you that the pandemic still exists and you got to be careful. Fauci's telling you that. But you're saying, no, it doesn't. I'm going to go out and see the largest ball of twine in Minnesota with my family. We're going to go on a road trip. And we don't have the money to do that, to go on that road trip, even though we really want to go as a family. We've been cooped up. But it's only going to cost maybe $800 to make the trip, and so we're going to put it on a credit card and we're going to pay it down over the fall. But it's no big deal because we've got some money in the bank. We've got like a little rainy day fund, and our credit card isn't maxed out yet. It was maxed out. It was maxed out in 2019, but then we paid it off in 2020, and so it's no longer maxed out. It's down. We're in at a very manageable level. So might as well put $800 on there because my kids are driving me crazy and I want to go out and see that ball of twine.
Yeah. That's real life. That's real life. And that's why we have forces in the international markets, which are a little bit of a problem. But we've got forces at home that can fight this beast, right? So I say here, Americans are going to dip more and more into credit this summer to keep demand high. So normally high prices cause people to consume less. That's what Emperor Powell is trying to do. So I phrase it this way, meaning I think Emperor Powell is about to fight a weird fire. His water is not going to do much about the fire now and could turn the fire into an explosion later.
It's gasoline.
Okay. Yeah, so here's how it works. Powell is making credit more expensive just when there is more need by consumers for it, and banks have space to make the loans on their books.
That's right.
So what Powell is doing is he's encouraging the market, the credit markets, to dip into more expensive and riskier loan taking by him raising the rates. Because remember, he's trying to get people to consume less. So he's raising rates to make it harder to borrow money, but consumers are saying, hey, I've got a great credit score. I'm not carrying a very big balance on my credit card. And my bank is like chomping at the bit to get me to take out more money. All Powell has done is make the credit that they were going to take anyway more expensive. So then I say this, when the credit runs out, the higher rates will cause a faster credit collapse once the banks run out of balance sheet space. So that's slightly technical, but just imagine for a minute that the banks get to the point where they say, we can't loan anymore. People want us to loan more, but we've reached that critical point. We're just not going to extend any more credit.
They were there in 2019. They were there in 2019, by the way. This was not that long ago. Yeah.
Right. And so once they get back to that spot where they've just maxed out, we have no more credit to extend, then things can kind of get hairy, right? Because now you have consumers who now have more expensive debt and they can't get new debt to help roll it over. And so now you've got a situation where the meme is, I don't know if you've ever seen this before, but it's a lady who's got a watermelon on a slingshot, and she lets it go, but somehow the watermelon doesn't release. It comes back and smashes her in the face. I think we're kind of setting ourselves up for such a scenario. But I say this, don't bet against America, right? It's summertime. There's credit space. The labor market is tight, meaning everybody's got a job. Home prices remain high. Employed Americans and homeowners will be able to get the credit they need to consume. Demand will remain high. Supply will remain crunched. Okay? Then I say, in these terms, inflation will persist, but things will hold together. Employed people with credit will allow consumers to keep the great ship of GDP going in a goodish direction. Trouble waters ahead for sure, but not yet. And then I finish my little Twitter rant, okay? So, Sam, any response to any of that fun?
You summed it up well. Keep going.
Okay. So this is Lacey Hunt. So we're about to talk specifically about the 10-year Treasury Note. So Lacey Hunt wrote this in Q4 of 2020. He says this, and actually, here we go. In sum, considering economic destruction placed on individuals and small businesses by the virus and its resultant shutdowns, the fact that fiscal expenditures have a negative multiplier on macroeconomic conditions, the debilitating impact on growth of excessive debt, and the restriction of the zero bound on monetary stimulus, a secular inflation cycle is not at hand. Okay, I want to talk about that. Since inflation is the primary detriment of the yield on long-dated U.S. government debt, it remains our judgment that the bull run in 30-year U.S. Treasuries is continuing. So this is from 18 months ago, but Lacey Hunt makes this really, really clear. So he's making two general points. General point number one, the destruction inside of the economy from the coronavirus and its shutdowns is enormous. And that stuff has not gone away. That's still, all of that destroyed supply and demand has hurt the economy. We've papered it over with credit, but it's still a problem, right? Add in the 4 threads of chaos. Again, I would recommend that everybody go watch Sam and I's conversations with Ty about this in the past. There's a lot of reasons to think that there's not going to be great growth in the future. The second thing that means is that demand was going to cool down and come down anyway. And so that also means that yields on the long treasuries were gonna continue to collapse. So this is the big thing, and this is what happened today in particular that's a big deal. So this is the 10-year treasury. So I have a little explanation here. To finance the public debt, the U.S. Treasury sells bills, notes, bonds.
I'm sorry to interrupt. Can we go back? I would love for the audience to hear what a secular cycle is.
Okay. So a secular inflation cycle is a cycle of time inside of the markets where high prices will continue because of the fundamentals of the economy. Okay, so if the great secular inflationary period in the US is the 1970s, the largest contributing factor to that inflationary period was the boomers consuming too much stuff. So as the boomers,
or as much stuff as they needed, not too much, right? Like it's
sure, yeah, I guess you're right. They just consumed like normal humans. It's just the economy. Yeah, the economy of the 1960s was not ready to supply the needs of the boomers in the 1970s. That's the better way to say that.
Yeah.
Okay, so that's a secular inflation cycle, and so Lacey Hunt, who was already 30, he's a very old person, so he was already 30 when the 1970s hit, and he made the call back then. He says, this is a secular inflationary cycle, meaning the fundamentals of the economy are going to push prices higher for a decade or more. So that's a secular inflation cycle. And it did. It lasted. He called it in 1971, and then he called it back at the end of 1983. So that turned out to be a 12 and a half or 13-year secular inflationary period. And he owned 0 bonds during that period because it was true inflation, and buying bonds during inflation is normally a terrible idea. Okay? And so now the next graphs that we're going to look at will make sense. So now if you look in 1975, there's all this gray space because that's a recession. And you see that during the secular inflation, so again, it kind of starts there on the far left, and then it shoots up until the secular inflation dies at the top of 1984. We sometimes call this the Volcker period. People like to give Volcker a lot of the credit. He was the head of the Treasury or the Fed, the Federal Reserve Bank of the United States in 1984, and he jacked up rates really, really high. I mean, people thought that helped, bring inflation down. Of course, Lacey Hunt would have said, no, the fundamentals were already pointing for that to kind of flatten out anyway. But since that time, since that peak in 1984, Lacey Hunt has said, bonds are a great buy because there is not enough fundamental inflationary pressure to keep interest rates high. And so you almost have a total collapse from 1984 to the present, except down at the bottom of 2020 there. See that little bottom? We had a little recovery in those treasury yields, and that's what's got everybody thinking that we're in an inflationary hell. Sam, do you have any comments about that so far?
Yeah, I'll just say it's absolutely ridiculous how much people are freaking out about this, given how little inflation has gone up from an interest rate perspective, right? And I do think, like, if you look at this chart, and I made this point. I think I actually had this exact same chart in one of my presentations, right? Like, there is, like, the only reason why we've been able to have the 30-year bull market in treasuries is because interest rates, and also the only reason why the government has been able to spend so much goddamn money is because once you spike interest rates that high, there's nowhere to go but down. And if all you have to do in order to spend more money in a long deflationary period like that is just wait a year, and you'll be able to borrow at a lower rate to refinance your debt from the previous year, which is what that's the same reason why the housing market is so inflated, why it's grown so much, right? Because if you bought a home in 1984 at 14% mortgage, and then every year you refinance your home, you just get cash every year for nothing. That's amazing. If you were able to pay that mortgage at a 14% interest rate, and my sympathies are with you if you did, you just, from there on, it's just easy street. So we're now at the point where we're getting close to zero, and I would say that the trend is gonna reverse. So maybe this is just peaking up for the first time as like a presage of what's to come. Maybe it's gonna come up and then come back down, and then it will continue up sooner than Lacey Hunt thinks, but so it's going to turn around, especially since the millennials are about to have their own little cycle as they save for retirement, right? But these, but like I think that there's no disputing that Lacey Hunt is right, that there is no indication necessarily that the cycle of downtrend in inflation is over. There's no proof of that, and it could very easily continue down. Looking at this chart.
Now, I know that in the back of all this, Ty is thinking, I'm going to call these guys out and be like, no, inflation's here to stay, and it's because of supply chain issues. And I want to address that in a minute, Ty. So I'm going to preemptively throw some cold water on you and say, can we talk about that in about 2 slides?
Sure.
Because it's an important piece to this. And Lacey Hunt is open. He's open about this, where he focuses on the U.S. economy, and mostly the U.S. economy. And the biggest thing that he missed in 2021 was that supply chains did not come back online. And he just missed that. And of course, the answer to that is mostly because of geopolitics, not because of American politics, right? So we'll talk about that in a second, and how that messes with prices. I just wanted to highlight 2 things that Sam said that are really, really important. Number 1, look at when the debt starts to take off. It's after the Volcker collapse, right? As rates are starting to collapse in that 84, 82, 83, 84 period, that collapses. Reagan comes in, and his people come tell him, hey man, these are the lowest rates we've had in like 6 years. You could probably start borrowing more. So he does. And then as his presidency continues, there's a little spike again, but it doesn't throw them into recession, and then they start falling. So they borrow more and more and more. And then they continue to fall into the 90s, and they borrow more. And then look, the rates and federal debt touch right as they balance the budget, right? And then after they're done balancing the budget, rates continue to fall, and then everybody post-Clinton realize, oh, we can borrow as much as we want. These rates are unbelievably low. Yeah. Right? They get below 1, on the short end of the curve, they got below 1%. So you could borrow money for 6 months at 1% or less. And once that happened, it became a spending bonanza. And it wasn't just the federal government, it was the whole economy started doing that. Normal Americans did it too.
Can I point out one more thing? So yeah, of course. There's been and this is a little bit of a tangent, but it's related. So a lot has been made of big financial institutions like BlackRock going into the property market and buying up homes, right? And I just want to point out the reason for that is on this chart, right? Like, first of all, if you're a BlackRock or some other giant financial institution, your primary mandate is not to make money. Your primary mandate is to protect the capital that you already have, right? So a lot of your money is going to be in bonds. But if bond rates are this low, you're not able to make enough yield to satisfy your customers. You've got to find another way to make yield. And also, if rates are that low, you can borrow a crap ton of money to go buy stuff with, go buy assets that could give you yield. And what is the most reliable source of yield that's not loan related? It's real estate. It's yes. Farmland or homes, so that renting properties. So they're able to get yield to make up that shortfall that they need to make their investors happy. Because that's what strategy they're pursuing, specifically because of this spread in interest rates that is hammering them from one direction, but giving them an opportunity in another.
Yeah, I think just to mention and to highlight this point, this is why the Federal Reserve Bank of the United States needed to include mortgage-backed securities inside of their bailout programs for credit markets, because the large institutions had taken on so many mortgages and they were treating them exactly like bonds. So not only was the government doing QE for bonds, they were also doing QE for mortgage-backed securities for the exact same reason, right? That behavior that Sam just described caused the Fed to react and start doing more of this balance sheet swapping with commercial banks so that they could take those mortgage-backed securities and put them onto the books of the Federal Bank of the United States, which is crazy. All right. Now it's time, Ty. Here we go. Inflation. So, what is it? It's complicated, right? So some people say it's an increase in the quantity of money. Some people say inflation is the decline of purchasing power of a given currency over time. Some people say inflation is the rate of increase in prices over a given period of time. And some people, and this is a minority of people, but they're out there, a continuous increase in the price level determined by the state. So this base.
Look at capital S, the capital S in there, the state.
Right, that's right.
That's a communist S right there.
That is.
Capital S.
That's right, comrades. The state will tell us what our inflation is. The MMTers think that, and this is like the quintessential MMT position. The MMTers think that credit flows, credit money, and actual printed IOUs are all within the purview of the federal government, and all the government needs to do is stop spending, and it will stop inflation. And frankly, they might be right. It just, that would cause deflationary hell if the government did that, but I digress. Okay. So let's talk about this. It's a question about prices, and this is economics, guys. This is the great insight of the 18th and 19th centuries. In the 18th century, we had a supply curve. People were so excited about the supply curve. That's Adam Smith. He only got that part right. Instead of having supply meet demand equals price, he thought supply meets labor equals price, which is interesting. And so did Karl Marx, by the way. And then in the 1800s, a different British guy was like, no. It's where supply meets demand. And once that happened, real economics was born. So we say, all right, where do supply... Yeah, before that, it was all just storytelling. We were really crappy at economics. We're still pretty crappy at it, but we were really crappy at it.
This is just infancy. I mean, everything that we think of as modern is just like step 2 out of infinity. So
yeah. There's so much we still don't understand about human behavior. Deeply complex system, but where aggregate supply and aggregate demand meet, that's where quantity and price are established. So you could say a lot of goofy things. The people who think that we just print a fiat currency, therefore inflation occurs and it's all the government's fault, are believers that P on the, the y-axis, P star over there on the left, they think that P star can move without demand or supply moving. Right? These are the inflationistas. These are the people who think fiat currency is the worst. Yeah, inflationistas.
What do you do this to me?
They're the libertarian fools is how I like to
call it. And some of the crypto bros. I mean, all of the crypto guys are
the Venn diagram overlap between the libertarian fools and crypto people are like this. So
yeah, that's well said. Well said. But the idea is that supply and demand stay the same, but government just messes with P without the actual fundamentals of the economy changing. Right? Now, that's an interesting intellectual model. I happen to more or less reject that. I don't think that's reflective of reality.
There is something to it, because what they're saying is that as the monetary supply increases, it's not that the location of P is changing, it's that the yardstick you're using to measure it changes.
No, and I understand that. But their point would be is that your store of value is eroding. And the thing that they ignore is that the price is a signal to supply and demand. So it doesn't matter, right? Like
exactly.
An inflation scenario signals to suppliers to produce more. And the reason that hyperinflations are so deadly is because suppliers no longer can figure out what the signal is from price to produce the correct number of goods. Okay, and that's when things fall apart. But it's like, guys, that happens so infrequently. Anyway, I digress. We don't talk about that.
No. I understand what you're saying. What you're saying is that it's not actually important that prices remain stable over time because the money supply remains stable over time.
Yes.
What's important is that it happens gradually enough that people can adjust their thinking, and it can and that P can remain a heuristic that people can look at in order to determine their decision making in the market.
That's exactly right. The organization of life around prices is the most important part of money. It is not the store of value. So it's all. I think all that's really happened is the store of value element or characteristic of money has been placed above all of its other important characteristics. Money is not just a store of value, right? If it were nothing but a store of value, then yes, the argument would make a lot more sense. But money has a lot of other characteristics other than just a store of value, including a signal to the world of what you should be consuming and not be consuming and what you should be making and not be making, right? And that's where inflations get really dangerous. It's not because your value erodes. It's because your economy stops making stuff. Your store of value doesn't mean crap if there's nothing to buy with the value you have. That's anyway. That's a different.
I was enjoying that. Anytime that anyone is dunking on libertarians,
It's just anyway. It does matter. I forgot. There's a couple of things I want to say about this. Now, the other way that you can mess with price, other than just inflating the currency or messing with fiat currency, is you could have demand and supply starts to move. So if demand shifts to the left and heads closer towards the y-axis, that's demand. That's a demand shock, and demand is destroyed. Okay. Excuse me, same thing. If supply shifts left, that's also demand destruction, and weird things happen. When demand falls and supply falls, which is exactly what happened during the lockdowns, you can imagine where price gets really goofy. Supply falls, which means there's less stuff being made, but fewer people want the stuff, and so the demand falls. If demand and supply fall at the exact same rate as each other, price might actually stay stable. The problem is they never do. So in this case, the government swooped in and said, we want to shove dollars through government action and artificially move demand up by doing the PP loans, the stimulus checks, the child tax credit, and all the other programs that they created, right? So they shifted demand to the right so that prices would remain high. They wanted inflation to occur, not because fiat currency had devalued the dollar, but because they needed people to consume, even though they were sitting at home, to signal to suppliers to keep working really, really hard, even though we were in the middle of a shutdown, right? Try to keep equilibrium as close to possible as we could. The problem is that demand and supply are dictated by other factors as well, and that's where Ty would rush back in and say, you guys are stupid. Supply is a geopolitical reality, and guess what? Supply is getting destroyed, and it's not coming back. Do you want to speak on that for a second, Ty?
Yeah, so I apologize. I'm looking at some messages, but there's also, just from the end of that, I agree, supply is getting fucked, but also a lot of things that people aren't putting into context is that demand's going with it. So y'all remember Zion's demographic, spiel, where you've got people who are rapidly aging. Europe is now going to be a consumption drought. You're not going to be able to sell any kind of goods in Europe that isn't pretty much healthcare and end-of-life care. Now, granted, I'm being a little hyperbolic when I say that, but when it comes down to the actual numbers here, if you're looking at Germany, they're going to have more people retired than people working in 10 years, maybe 15. What does that do? Right. What does that do to a modern functional economy? You're going to see demand for housing, for gasoline, for pretty much any normal thing that we consider consumer goods go out the door. You're going to see people who, largely save just for their healthcare expenditures or whatever they need to get by, and that's it. Like, I mean, playing cards is going to be through the roof, but how many can you sell those? I'm memeing here a little bit, but that's kind of what the world that we're looking at. Europe is already becoming an old folks' home. The developing world is now, on their average age, about 30. Outside of, like, Mexico, if you're looking at China, if you're looking at most of the former BRICS, most of these people have a baby boom generation that's about my age, about all of our ages. But there's no one younger to fill them out. We can talk about how small the Zoomers are and how small Alpha is. Everyone else puts them to shame. And so, the developed world, consumer-led, consumer base, they're already gone, and they're just literally about to walk out the door. The developing world, to a large degree, they're about to walk out the door. They'll be walking out the door with our generation. And the only people that are left are either third world countries that have the most extensive birth rates in the world. Oh, and by the way, they're looking at famine conditions this year. Or you have a few weird random nations like the United States and France and Sweden that permeate the world where they have a generally balanced demography. Why do I say all that? Supply is crashing, yes, but demand is crashing with it. And I don't want to see what that does to prices because it's going to be stupid.
Right, it'll just continue to slide down and down and down. It's one of the great deflation hell columns, right? It's one of the pillars of deflationary hell. Now, Ty, I have a question for you. As you were discussing this, the thought came to my mind that although supply and demand are going to collapse at the same time, do you think that supply collapses ahead of demand only because people retire and then continue to consume until death? I mean, they probably consume less, right? I'm just trying to think through this. Do you have an opinion that maybe supply might collapse a little bit quicker than demand will?
There is, I want to put it this way. There's a yes and a no to this in my head. The yes is that people will consume even after they retire. So you're absolutely correct on that. The no is that supply is actually far easier to meet 9 times out of 10 than the demand is. The demand curve hardly ever moves. You know, we can talk about elastic demand all we want, but most things are actually semi-elastic, and if anyone doesn't know what the hell I'm talking about, it's this. People want things. Now, you can move that demand. So let's say you like your meat, right? You like chicken, but sometimes you'll sub out for steak, depending on that. The amount that you move is called inelasticity. And there's things that you're always going to need. Healthcare, drugs, shit like that, right?
Especially if you're old. You're all about the drugs and the healthcare.
Yeah. There's things that, gasoline to get around. There's things that you can kind of go without or sub out, such as... largely we see this with crops, actually, is that you might get some corn here, but you decide, no, I'm going to get more bread or whatever. And then there's some things that go completely out the door, but they're very few and far between. And the longer that you make the time scale, the more that you find that demand really doesn't change that much. It'll change temporarily, but not long term. All that's a big brain way of saying, if you actually go up from the supply metric and you go, hey, we need to increase production, even if you have to raise the price up, it is far easier to bring prices down and into equilibrium by, on that graph there on that you guys can see, moving the supply index on that.
Unless your supply chains are so effed up, how do you get supply back up? I mean, my thought on this, Ty, is before we get to deflationary hell, if supply shifts left, so it gets closer to the word price in the top left-hand corner, where it crosses demand will be at a higher price, but that price can't signal bring on more supply because supply chains, due to geopolitics and demographics, make it really difficult. I think you're right historically that supply is a little more responsive to the circumstances and price, but they just may not be able to this time.
But Nate, if the price goes higher, then it makes it profitable for places to industrialize that it wasn't profitable to industrialize before.
Sure.
So what that means is
you reshore to America.
Exactly. Or North America, even if it's not the United States. Because
we'll throw Mexico in there. It's not Canada, though. Sorry, Canadians. You're not going to be a part of the Renaissance.
Yeah. So...
I'm sorry, just to to put my final thoughts in this one, because I want to hit this. There is a conversation that I've heard about, will supply chains buckle before people can get the new stuff online? And there's two thoughts on this. Number one, are you going to have a society that preemanates fixing what it needs to, where it says, hey, look, we're going to put our capital and our resources into microchips so we can get what we need to fix our issues? Or are they just going to let the market solve everything? Don't get me wrong, I like markets, but it's the industrial tools conundrum that if you all know your history at all, the best way to get more industrial tools is make industrial tools. And that's one of those deals, too, where more often than not, you kind of need an act of national security to be like, hey, guys, this comes first. You have to put 40%, 50, 60% of your domestic output to get your new shit. The United States hasn't done that. No one really has. So are we going to see that collapse again? I don't know, because the last I've heard, we're looking at still about 30 to 36 months for the new semiconductor plants here in America to be built and to have their first production runs.
To come online, sure. I just wanted to take a quick second and give a shout out to Phil KOE, who's entered the chat. Phil, we love you. He also declared to the chat that we're already in a recession. I think I would, just to put a cherry on top of this conversation about, I'm of the opinion, and as we've talked through it, I've become more persuaded by this. I do think that supply has shifted left, demand has remained the same, and as a consequence, prices are elevated and will remain elevated. The Fed knows it can't bring more supply online, especially quickly. Ty just mentioned that it takes time to reshore, to retool, to do all that kind of stuff. The Fed can't force that to go faster. And so all they're left with is trying to shift demand down. So even if technically GDP remains flat, the American public is going to be fit to be tied, because they're going to be staring at increased prices without very much new supply coming online this year and probably into next. And so they'll continue to dip more and more into credit cards to make up the difference. And by the end of this year, you're going to have some pissed consumers, because they're going to get close to the end of their credit. Their jobs haven't given them very much, or if at all, of a raise, and gas is still going to be super expensive. Nat gas is going to be expensive, so if it's cold this winter, buckle up. You know what I mean? Like,
yeah.
An elevated supply curve that is not going back down, even with extra money flowing in, and demand staying high, is sort of a recipe for elevated prices, which is a form of inflation, even though price stability from the Fed perspective is more or less happening the way it should. The supply of money is stable, but prices remained elevated because supply is just too messed up and demand remains the same. So either folks have got to die, choose not to consume more even though they've got credit cards. We've got to bring supply back online, or else we're just going to remain miserable, even though I think the economy will, by the numbers, continue to have strong employment and okay GDP growth, which is like super confusing. I don't think I've ever contemplated such a scenario, but I think that's what we're staring at.
Yeah. I've pissed in a few Cheerios with this. I'm not 100% convinced that we're going to get there, but, right now is openly to that point where we could. I was calling for years, but we were going to have stagflation. That we were going to see inflation, and more inflation, and sooner or later it was going to roll into recession. I don't know if we're going to see that. I know right now things are leaning my way, but, I'm not going to count my eggs until they've actually hatched, because I don't expect like 1 or 2 months of this kind of thing. I expect that if we're going to see stagflation, it's going to be 3 to 5 years. Now, did we maybe walk into that? Possible.
Well, Ty, isn't the scenario I just described, wouldn't that to most of America feel like stagflation?
If it doesn't feel like it, if it is, if it isn't stagflation, it's going to feel like it, yeah.
Yeah, because you might have slight GDP growth, right? Like, let's say Q2 and Q3 have 0.1% GDP growth or some, nominal amount. It's technically growing, but inflation and prices remain high, and so people will still, they'll just be pissed. We're going to have a lot of pissed Americans.
So, how many of the audience, I'm curious, and obviously you two, were adults in like 2009, 2010, 2011, 2012, 2013?
I was an undergrad. Yeah, I was an undergrad.
Okay, so...
But of course, I was slightly older undergrad because I did my 2-year mission first, so I would have been... How old was I? I would have been 23, I think, as the crisis was abating, 22 when it hit.
Yeah.
Holy shit, you're old.
So for those of... So I'm way older than either of you. So for those of us who were around during that period and in the workforce, it felt like what you're describing, just less intense, right? It's that inflation was really, really, really low by all government
measures, right?
Right, but because there was no opportunity to get ahead or buy assets if you didn't have a high income, and because people were stretched to the limit because of the downturn, and they didn't have excess cash floating around, it felt like prices were moving. And so,
interesting. Okay.
right, like so if what and it's what created this era that we're in right now, right? Like I would say that the era of unrest that we're in right now, with Black Lives Matter and Gamergate being the two inciting incidents in my mind,
right.
It was because the underlying factor. Obviously, they had their like cultural reasons for manifesting in the way they did, but the underlying factor was that nobody could get ahead. And even though inflation was low, it felt like they were falling behind. And even that was an elevated level of the same exact dynamic, which had been over the last 40 years. And so that gradually people have been falling behind. If you don't own assets, you've been falling behind. And if you can't get it together to buy the assets, you're going to fall further and further behind. And if what we're entering is what you described, where where prices are elevated compared to where they were, that is in people's recent memory. Like we can remember, $2 eggs, but they can't see that anymore, and they won't for a while. And they're spending money on a credit card because their budget is in the negative, like they're in the red, their household budget.
Right.
And everyone they know is experiencing that too. They are going to flip out, like you said. And I'll just say that that's not new. It's just a more intense version of what has already existed.
Right.
And my observation about this, and this is completely nonpartisan observation, even though I'm a partisan person, but my observation about this is that there are a lot of people out there who have been acting in positions of power specifically to try to keep the system together.
Right.
Rather than to meet their political obligations, which is to make sure that the thing that actually provides stability, which is to make sure that their constituents feel prosperous.
Right.
That's what provides stability, is when your constituents feel prosperous. Holding the system together in the way you described, like what we've just been establishing, is that things are going to feel a lot worse to the average person. But because of credit expansion, the system's not going to completely collapse yet.
That's right. The system survives.
And so this gets back to the point that we always end up at the end of these conversations, which is that the system either collapses under its own weight or it gets torn apart forcibly by populist energies from the left or the right, or both. They can both the left and the right can form a populist pan-ideological coalition to tear this shit apart tomorrow very easily.
Agreed.
And
that's interesting.
And so the longer it goes on, we don't know which one it's going to be. But if you look throughout history, there are examples of both. There's like the Great Depression is a good example of the system falling apart before
the politicians get there.
Before the politicians get there.
That's what I was going to ask.
And the French Revolution is a really good example of the reverse.
The politics arriving before the total collapse.
And the populist revolution happens, tear down the system before the system just goes ahead and collapses. And so what I would say to those who are thinking, no, let's keep the system stable, is I think you may end up with the same result, but a lot more negative externalities associated if you consider rich people ending up with their heads on pikes as a negative. Because because you're gonna end up with the system dead either way. But you like what we literally have here now is if you're a homeowner or you own a lot of stocks or if you own a company or two, like Elon Musk, for example. Here's a guy who has talked a lot of populist game, but he is completely his net worth is 100% associated with the debt cycle.
Assets, yeah.
It's the debt cycle specifically because none of the assets he owns are profitable, and they're all speculative.
Yeah, so the richest man on the planet.
Right, and he wants to buy Twitter right now, and now he's backing out of the deal because he realizes that if the stock market continues to go down, whoever is supplying him with the loan needed on the collateral of his Tesla stock in order to buy Twitter is just going to take his collateral and liquidate his fucking loan, and so he'll end up with nothing. And so he has to back out in order to and act like it's Twitter's fault to save face, but really he can't do anything, and he is trapped in this system just like the rest of us. And so I would say that for those who want to keep the system going as it is because they're asset owners, whether it's a small time person who's a homeowner or and just has like a good $100,000 a year job, or whether you're a business owner of a small business that pulls in a couple mil a year, or whether you're a titan of industry, if you want to see this system continue, you're done. Sorry, it's not going to happen. But you may want to choose how it's basically the public, whether they know it or not, has a gun to your head saying your money or your life. You're going to lose your money either way. Do you want to lose just your money, or do you want your family murdered in front of you before they cap you? Because that's literally what's that's the direction we're going in here. If the system doesn't collapse first, I pray that the system collapses before we get to the point where people are being murdered in the streets. Because
technically, okay, all right. This gets us slightly off topic. But Sam, there were a couple of shootings this last week. The Buffalo shooting soaked up most of the attention, but there was also a shooting, I think it was in California, at an evangelical church with Taiwanese people that predominantly attend there. What if we were to draw the Venn diagram of how much of this is the angst of the system falling apart versus the angst of just these are terrible people? I mean, I don't know. I feel like it's the angst of the system gets terrible people to do terrible things, right?
So, speaking as someone, this is like all this stuff I've been sort of speculating and playing amateur analyst of economics, even though it's not my specialty. What I am a specialist in is politics, and I can tell you, as someone who deals with a lot of voters, is that people who don't vote a lot, everybody just assumes that they're like moderates, but that's not true. They're actually extremists. They just are extremists who are so disengaged because they don't believe in the system that they just don't participate, right? So if you can convince those people, that's what Donald Trump did. He convinced people on the right who didn't even give a shit about what elections did. They were just going to stay hunkered down with their guns. He said, "No, actually vote," and they did, right? So all
the people staying at home are the psychos.
You have no idea how many people I've talked to in like Silicon Valley who are like, they come to me because I see ideas every now and then from people who want projects, and they're always like, we want to encourage more civic participation from non-participants, and I'm like, do you know who these people are? You are a political moderate who wants to see moderate coalitions exist. You don't want these people to vote. I want these people to vote because I want to see the system torn down. So I think that the people are terrible regardless. Yeah. The question is how motivated they are to take action on their terrible, sadistic, brutal, vile instincts. Or whether they're fat and happy enough to just sit at home and eat chips.
That's right. We need more Mountain Dew and we need more Doritos to hit the market at a lower price point. That's all I'm saying. But no. So Sam, do you think when you talk about possible violence in the streets, I don't think it's going to be this organized deal. It's going to be like the stuff that we're seeing just all the freaking time, right?
Yeah.
Like you're just going to
here's where I'm going to depart from my Democratic friends quite a bit, right? I saw a lot of people, most of the people I know who work in politics were like, Donald Trump is directing this party. He is pointing and people are following, and he's convincing people to do hateful acts. I didn't see that. I saw a man who was running scared for his life, because if he didn't hop one step ahead of his base, which was driving him toward violence and brutality, if he didn't stay one step ahead of them, he was the first one to go to the headman's axe.
Right.
And
yeah.
then everyone would be next. Right. So
that's an important dynamic. Yeah. I hope everybody in chat just heard that. Is that the political leaders, as this thing starts to fall apart, it's either become the head of the mob or become its first victim. Right. Like that's a difficult dynamic.
Look back on Mussolini. Look back in history. Right. Like here's a guy. And
Robespierre.
And Franco. All these guys. Right. Like I mean. Lenin,
Muammar Gaddafi,
Stalin,
Lenin,
all of these people, you end up in these situations where you are not in control. And so you can be very comfortable riding the lightning, but sooner or later the lightning rides you.
Jeez. Could we call this in like a much nicer way, the Glenn Beck effect? So like Glenn Beck at the end of the election with Trump, he sort of started talking out and being like, oh, I made so many mistakes, I'm so sorry. And then 6 months into the Trump administration, he was back to just sucking the teat of his audience and like going back to the Democrats are the worst. Trump actually was the second coming of Jesus. I forgot. Like, unreal. But yeah, I mean, that's that kind of behavior, right?
Right. And none of these people actually believe anything they're saying. Like all these people who are saying the word grooming, who are elected officials, they don't believe that anybody's grooming anybody. They don't believe anybody who's heard a right-wing politician say, oh, like the Democrats are like a pedophilic conspiracy. They don't believe that either. They're just going along with whatever you think, and you've passed around with your friends, and they're just saying, yeah, I do that too, so that they can benefit, so they can saddle you up like a horse and ride you to victory, to electoral victory and personal profit. They're going to extract money from the system for themselves based on your belief. And I'm not saying the Democrats don't do this. I'm saying that if you think the Democrats are the only ones doing this, you're dumb.
You're an idiot. I have a buddy, he and I talk about this all the time, where he goes, we're in the get yours culture, right? Like if you're a person who's in a position of any sort of authority, your only real incentive right now is get yours and protect it.
And protect it because you realize that everything is going to collapse. So you got to do whatever you can.
Incredible.
Yeah.
Oh, and it's so funny that sort of like everyone's like, oh, the deep state's so terrible. They pull all the strings. The deep state's the one that's like, good Lord, this thing's about to go up. The Hindenburg. I'm gonna create a nice little nest egg for myself and get the freak out of here. They're not interested in running your lives. They just when there's blood in the streets, they want to be in a compound someplace. That's what they're doing.
Yeah, they just know better than you what's possible. That's all.
Yeah.
Bunker down.
Yeah. All right. Well, we've hit the close to the 90-minute mark. This is normally a good place for us to break. All our fun's
it's
just so
over.
fun. It's so fun to talk Doomer stuff with you guys. I just want to remind everyone the actual theme of this particular conversation is the doom is not yet. Credit will hold us together.
Yeah, and also, even after the doom happens, we're still headed all the way up to heights you've never before seen on an unimaginable wave of prosperity that's coming behind it. So, like, I'm not saying there will be heaven on earth. I'm saying that if compared to what we know now,
if you survive,
we'll never even get to see it. We'll never even get to see it. But if we act responsibly and accept the fact that we're all going to be poor together as one America. Thank God we're all going to be poor together. Jeff Bezos and us are going to be living on the same block, having the same block parties. We're all going to be poor together. And as long as everybody's okay with being poor, it means that our kids and their kids are going to be rich.
Do not want to be poor.
Yeah,
Too bad. And this is our patriotic duty. Our patriotic duty to accept being poor so that our kids can be rich.
I agree. I just think, what's our population right now?
330 million.
How many of those are not going to accept the poverty line?
All the boomers are going to not accept it because they're a bunch of snowflakes. And they've been calling us snowflakes, but if a U.S. president called on the millennials and said, you got to live on a commune doing farming, and you got to harvest strawberries every autumn. Right.
Sam and I are coming to your house right now.
Then you think, if you don't think that millennials would answer that call, you're crazy. We would go from being latte sipping assholes to people building fences with our bare hands in literally a week, and it wouldn't even be that hard. And we would answer the call, and that's just the type of people that millennials are. So I look forward to that time.
That's actually the thing that I want to close out on, because I've been thinking about this, and I've actually done a little bit of my little like semi TikTok videos that I've been kind of like doing there, just to kind of spread out the love and the knowledge. What I'm looking at for me personally is that the millennials are going to be the make or break decision, right? Fourth turning, all that stuff. That's true.
Yeah, it's
and
true.
there's things that I look at the millennials and I'm like, oh, we're so fucked. But there's also things that I look at the millennials and I'm like, you know what? We might have a shot at this. I'm not going to get into the details of that. Y'all can look at that on the YouTube. It's up there. It's a little like 3-minute videos as far as like where we are. What I do think is that if we take this why correctly, when we go off in the right direction that we need to, and I'm not saying what that is, but I'm just saying if we do, we could have a era of prosperity that makes the 50s look like a sham. But if we don't take that why correctly, you are going to see basically fascism in America. Like, there is no way in hell that I don't see it going any other way. We have a choice. There's going to be some hard choices to be made. There's going to be some really tough battles to be done. But if we do this right, there is absolutely every reason to hope. And without further ado, Nate Dallin, do you have the you get the last word?
Credit's going to hold us together. Don't let the doomers convince you otherwise, at least not yet. There will come a day when we have a conversation. Right. There will come a day that the three of us get on here and we go, guys, it's next week. We're
time to get out.
We're going to we'll all be calling in from undisclosed locations because the purge is on, right? But today is not that day, and I do not believe it'll happen in the next 9 months. We'll make it into next year. We'll be all right.
All right, fantastic. Everyone, I hope you have been having a wonderful time. My name has been Tyberius D, and I appreciate you all joining me for the conversation. This is basically what happens whenever I don't have the full mask-off army behind me, although our good friend Nate Dallin is a full-on mask-off member. And Sam, we would love to have you on as part of the mask-off army as well. I know that you are a very busy man. Kids are absolutely... quite a lot of work, but if you could get there on... Go ahead.
Nate has kids. He thinks it.
He dips out a lot. He has to dip out a lot. But yeah, guys, I appreciate each and every one of you for being here. Whether you are out here on the Twitch, on the YouTube, I appreciate everything you do. And if you want more of this, I do gotta ask, throw me a little bit of subs on Twitch. Throw me a little love on Patreon if you're on the YouTube. That's the way to do it. I've got 5 patrons now for the Patreon. We're working about $32 a month, and I want to thank all those who are a part of that system, which one of them is our good friend Sam Drizzy here. I really appreciate all the help you guys do, because you guys just made it to where my finances were short up this month. Because I know you all feeling squeezed, but I need every little bit helps. And I want to give a massive shout out to our good friend, the West Dude, over on Twitch. He has been bankrolling the shit out of us with a combined total now on the Twitch channel of over 750 gifted subs. So yeah, and if you don't want to do the math, that's $5 a pop for each one of those. So without further ado, this has been The Conversation, joined by Nate Dallin and Sam Drizzy. We'll catch you guys hopefully next Thursday. Without further ado, have a good one.